Most people think the market is a voting machine powered by opinions, headlines, and emotion. They think Wall Street wakes up, reads the same news everybody else reads, and then decides whether to feel brave or afraid. That is not how serious money moves. Serious money moves through doors. When one door opens, capital runs through it. When that door narrows, capital backs out and looks for the next room. That is how I have always thought about markets. Not as a theater of predictions, but as a migration of capital. Money is never still. It is always looking for better odds, lower risk, stronger earnings, cleaner balance sheets, or simply a place where fear has pushed prices below value. That is why I get irritated when I watch the public get fed slogans while institutions get fed maps. The ordinary investor is shown a dramatic headline: ceasefire war, oil spike, tech crash, relief rally, flight to safety. The wealthy client gets something very different. He gets a scenario tree. He gets a list of sectors. He gets a ranking of probabilities. He gets a map of where money is likely to go if peace holds, and where it is likely to run if peace breaks. That difference matters more than most people understand. If you think the game is about predicting the next headline, you will live inside reaction. If you understand that the game is about following capital from one door to another, you begin to see the market the way a steward of capital should. I want to talk to you about that difference, because it sits at the center of almost every costly mistake people make when the world gets noisy. When I read a note like the one behind this discussion, I do not begin with the stock picks. I begin with the machine underneath them. I ask a simple question: what is the market rewarding if the fear subsides? And what is it punishing if the fear spreads? That question will take you much farther than any hot tip. The first thing you need to understand is that the market is not pricing one future. It is always pricing a contest between futures. That is why the same day can contain both panic and opportunity. The crowd sees contradiction. I see a machine deciding where the next dollar wants to live. That is the first mechanism. I call it the scenario machine. A great many investors think they are investing when in fact they are only reacting to the loudest story in the room. The scenario machine works differently. It says if the ceasefire holds, certain sectors get oxygen. If the ceasefire fails, a different set of sectors gets oxygen. If oil falls, one branch of the tree lights up. If oil spikes, another branch lights up. The point is not to be omniscient. The point is to stop behaving as if only one path exists. The retail mind usually wants certainty. The market never gives it. The market pays people who can operate under conditional probability. That difference sounds intellectual. It is really emotional. Most people do not lose money because the market is too complicated. They lose money because uncertainty humiliates them. They want the comfort of one clean answer: buy this, sell that, risk on, risk off. But capital does not move according to slogans. It moves according to relative attractiveness under changing conditions. Once you accept that, the market stops looking like random cruelty and starts looking like a system of rotating preferences. Now, let us talk about why the ceasefire matters so much in the first place. A fragile ceasefire in the Middle East is not just a diplomatic headline, it is a pricing hinge. If the fighting cools and the shipping routes remain usable, oil pressure can ease, the dollar can soften, and the market can begin to reprice growth, cyclicals, and risk assets. If the fighting spills, the opposite can happen. Oil can squeeze higher, the dollar can strengthen, fear can widen, and capital can stampede into the narrow basket of things people buy when they do not trust tomorrow. That is not philosophy, that is portfolio construction. A lot of people hear a setup like that and think the only intelligent move is to do nothing until certainty arrives. That is another mistake. By the time certainty arrives, prices have usually moved. The market pays anticipation better than confirmation. Not blind anticipation, conditioned anticipation. That brings me to the second mechanism, and it is one of the most underappreciated forces in the whole market. I call it the positioning spring. The public spends most of its time talking about stories. Professionals spend far more time talking about positioning. I care deeply about the story. If everybody is already leaning the same way, there may be less money left to keep pushing that trade. A hated sector with good earnings can rally violently. A beloved sector with crowded ownership can disappoint people even on decent results. Price is not just a reflection of reality. It is reality filtered through prior expectations and prior positioning. That is why a deeply disliked technology sector can become more attractive, not less. If earnings are about to arrive and the crowd has already spent weeks punishing the stocks, if expectations have been lowered, if institutions have grown defensive, if investors have spent months talking about war, oil, and whether artificial intelligence is overhyped, then you do not need perfection to get a rally. You need results that are less bad than fear assumed, or simply good enough to force money back in. That is how springs work. The more compressed they become, the more forcefully they can release. I have seen this pattern all my life. A sector gets loved too much, then hated too much, then rediscovered. People think markets turn on headlines. Often they turn because the last seller is getting tired, when the technology giants have been sold hard into a war scare, while an earnings season approaches and institutions are underexposed. You do not need to believe in magic to see the setup. You need to see human nature. Fear overshoots. Positioning overshoots. Relief can become fuel. That does not mean the trade is risk-free. It means the asymmetry changes. Now, let me show you how that asymmetry gets amplified. The third mechanism is what I call the leverage snapback. Most people hear the phrase hedge fund leverage and their eyes glaze over. That is a mistake. Leverage is not a technical footnote. It is gasoline. When leverage money cuts exposure, it does not just create a little softness. It creates absence. It removes bid. It leaves sectors thin, fragile, and underowned. Then, if the macro backdrop stabilizes even a little, those same funds can rush back toward the assets they cut because they are no longer protecting themselves from disaster. They are now protecting themselves from missing the rebound. That is a very different emotion. People imagine greed and fear as opposites. In markets, they are often sequential. First, the manager fears losing money. Then he fears underperforming. Then he fears being left behind by peers who moved faster. When that sequence starts, the snapback can be much stronger than the original fear would suggest. If funds have reduced leverage meaningfully from prior highs, and if a ceasefire or debt escalation keeps the worst energy scenario off the table, then the buying power sitting on the sidelines is not theoretical. It is real. It has career pressure attached to it. It has quarterly reporting pressure attached to it. It has benchmark pressure attached to it. That is why market rallies can look irrational to people who only read headlines. They forget that the biggest players are not trying to win debates. They are trying not to be wrong for very long. I learned early that the market does not care how elegant your explanation was. It cares where the money must go next. That is why I do not ask whether hedge funds were recently cautious as an academic question. I ask it because caution today can become buying tomorrow. Then there is the fourth mechanism, and it is one of the easiest to miss because the public believes its own fear is evidence of prudence. I call it fear exhaustion. When ordinary investors get frightened enough, they begin doing the same thing day after day. They sell, they hide, they move to cash. They tell themselves they are being disciplined. Sometimes they are. Quite often they are simply arriving late to a mood. When everybody around you is scared, fear feels like intelligence. But mass discomfort near the end of a sharp swing is not always intelligence. Sometimes it is just exhaustion. If retail sentiment has deteriorated, if people have been dumping stock exposure repeatedly, if leveraged products have become one-way expressions of panic, then the marginal seller can run out. Once that happens, you no longer need great news. You need less bad news. You need an opening. You need just enough relief for the exhausted seller to stop swinging. That is why terrible sentiment can be a better starting point than cheerful sentiment. I am not saying that every frightened market is a bargain. I am saying this. If the public is despondent, institutions are light, leverage has been cut, a major sector has been beaten down, and the event everyone fears begins to stabilize, you now have multiple mechanisms pointing in the same direction. That is when a market stops being random and starts becoming understandable. Now, a smart person should ask, understandable for whom? Not every branch of the tree benefits from the same outcome. If the calmer path holds, the report's logic points toward a certain pattern, smaller companies can get a lift first because they are often more sensitive to broad risk appetite and easier financial conditions. The Nasdaq can catch a stronger bid because technology has already been bruised and earnings are near. The broader SP can follow. Consumer discretionary businesses can participate because a calmer energy backdrop gives households a little more breathing room. Financials can do better because calmer macro conditions tend to improve confidence in the banking environment. Home builders and retailers can revive because lower anxiety is not just a market input, it becomes a consumer input. And if the dollar weakens, metals can respond. If metals respond, miners can get a bid. Not because some television host suddenly loves them, but because capital is repricing the same macro shift through a different door. That is the kind of thinking I wish every investor would learn, not what is the one winning stock. But if this macro branch wins, which groups become structurally more attractive and why? Now let us be honest, because honesty is where discipline begins. The other branch of the tree is not trivial. If the ceasefire breaks, if attacks spread, if Saudi production is threatened, if shipping routes tighten further, if Red Sea disruptions worsen, then oil is not a headline anymore. It becomes a pressure transmitter. A stronger dollar can emerge. Growth expectations can get cut. Risk assets can cheapen further. Tech can get hit again, not because the long-term story disappears, but because liquidity and confidence move against it. In that world, the market becomes far narrower. Energy producers, energy services, storage, pipelines, defense names, perhaps fertilizer businesses in the right circumstances. Those can become the doors capital runs through while much of the rest of the market gets repriced downward. That is why mature investing is never about attaching your identity to one sector. It is about attaching your discipline to a process. People who are new to markets often want a tribal answer. Are you bullish or bearish? Are you pro-tech or anti-tech? Are you for gold or for stocks? Those are the wrong questions. I am for value. I am for odds. I am for understanding which door capital wants if one path opens and which door it wants if another path opens. That is how you stop being ideological and start being useful to yourself. This is where the identity flip matters. Most investors spend years behaving like headline spectators. They believe their job is to absorb news, feel something about it, and then place a trade that reflects that feeling. That is not investing. That is emotional translation. The higher identity is different. You stop acting like a spectator and start acting like an allocator. A spectator asks, "What just happened?" An allocator asks, "Where does money go now?" A spectator says, "This headline feels scary." An allocator says, "What was already priced? Who is underexposed? Which sectors are overowned? What gets stronger if this branch continues, and what survives if it fails?" That is a completely different person. The spectator wants to be told what to think. The allocator wants to understand how money behaves. Once you become that allocator, the market becomes less frightening, not because it gets safer, but because you stop insisting that uncertainty should disappear before you can think clearly. There is another mechanism here that I think deserves a name because it ruins more portfolios than recessions do. I call it the headline tax. The headline tax is what you pay when you allow drama to substitute for structure. Whenever the world gets noisy, the public starts overpaying for obvious stories and underpaying for neglected probabilities. If war headlines dominate every screen, people feel clever buying whatever has already spiked on fear. If relief begins to appear, they chase late because they do not trust the calm until prices have already moved. They buy insurance after the fire has reached the kitchen. They buy growth after the rally is already obvious. They do not realize they are paying a tax for refusing to think structurally. The market charges that tax every year. It charges it to the person who buys energy after the panic has already crowded into energy. It charges it to the person who sells quality technology into a fear washout without asking who will have to buy it back if earnings hold. It charges it to the person who confuses the emotional intensity of a story with the duration of its financial consequences. I have made plenty of mistakes in my life, but the mistakes that haunted me longest were not the ones where I lost money, because I was early. They were the ones where I let the obviousness of a headline bully me into forgetting how capital actually behaves. That is why I return over and over to simple questions. What is already priced? Who is trapped? Who is underexposed? What improves if the feared outcome fails to arrive? What gets hit if the feared outcome persists? Where is capital likely to run? Not in theory, but in practice. That framework sounds plain. Plain is what works. I have no interest in sounding sophisticated if sophistication makes me slower. Now, let me talk to you about the part of this that matters most for ordinary people. Many investors assume that the institutional advantage is access to information. It is partly that. But the bigger advantage is access to frameworks. Wealthy clients get scenario logic, they get conditionals, they get weighting, they get rank pathways. The average person gets fed fragments. One headline says tech is dead. Another says oil will destroy the economy. Another says the rally is back. Another says buy defense. Another says buy gold. Most people do not need more fragments. They need a way to organize them. If I were teaching a young investor how to think through a setup like this, I would tell him to build an operating system, not a prediction. The operating system has 5 parts. First, define the hinge. In this case, the hinge is whether the conflict cools enough to keep the worst supply shocks off the table. Second, define the capital doors. If the hinge improves, which sectors gain oxygen? If it worsens, which sectors become refuges? Third, define the positioning. Which areas were already sold? Which areas are crowded? Which managers may need to add risk if calm returns? Fourth, define the time pressure. Earnings seasons, reporting periods, fund leverage, and cash sitting on the sidelines all matter because they shape speed. Fifth, define your own behavior in advance. What will you buy if the calmer path strengthens? What will you avoid if the fearful path crowds out value? How much will you commit? Under what conditions will you change your mind? That last point matters because most losses in volatile markets are not intellectual. They are behavioral. The investor has no contract with himself. So he improvises, he buys because something feels urgent. He sells because something feels unbearable. He mistakes activity for control. I would rather have a simple written plan than a brilliant nervous mind. The market punishes nervous brilliance all the time. There is one more piece of arithmetic I want you to think about because it reveals how upside often emerges from discomfort. When bearish positioning is already extreme, subsequent 3-month returns have historically been strong. That does not guarantee anything. History is a guide, not a contract, but it tells you something important. Great returns do not usually begin from universal confidence. They begin from uneven positioning, compressed risk appetite, and assets nobody is comfortable owning. That is the very thing most people cannot stand. They want to feel safe at the moment of purchase. Markets usually charge a premium for that feeling. If you insist on emotional comfort, you often buy after the hard work has been done by other people. I would rather buy with a sound process and mild discomfort than with euphoric certainty and a rich price. That principle has served me better than almost any formula. Now, I want to address something that always comes up whenever markets are this twitchy. People ask, should I just wait until everything is clear? My answer is usually no, not if by clear you mean obvious. Clarity in markets is often expensive. What you can do instead is move from fragility to readiness. You can know which doors capital is likely to use. You can know where fear has probably overreached. You can know which sectors you only want if the darker branch of the tree grows stronger. You can know which quality businesses you would be delighted to own if panic hands you a discount. That is enough. You do not need omniscience. You need readiness. Readiness is cheaper than regret. I also want to say something unfashionable. Not every opportunity has to be thrilling. A lot of people want markets to feel cinematic. They want a secret symbol and a giant payoff. But when capital rotates, A perfectly ordinary sector can become temporarily attractive. Waste payments, banks, builders, miners, logistics, boring businesses can suddenly become important because money is not searching for excitement. It is searching for relative advantage. That is another lesson the public misses. You do not need a sexy story, you need the right side of the flow. Now let me bring all of this back to Buffett, because I am speaking in the first person, and I ought to tell you exactly how I would frame the lesson. I would not tell myself that J.P. Morgan likes this or dislikes that, and then pretend I have done the work. I would tell myself something much simpler. The market is showing me a capital rotation machine. On one side of the machine sits relief. If relief deepens, hated growth. Selected cyclicals, financials, discretionary names, and parts of the metals complex can all get repriced, because the crowd leaned too hard into fear and now must unwind. On the other side of the machine sits escalation. If escalation deepens, oil pressure, dollar strength, and narrower leadership can dominate, and then I want to know where the defensive or inflation-sensitive flows are likely to go. My job is not to worship either side. My job is to understand both sides better than the average participant. That is what real investing feels like, not certainty, preparedness. There is also a moral dimension to this, though people dislike talking about morality in markets. If you remain a headline spectator all your life, you hand your judgment to louder people. The television does your thinking. The brokerage note becomes scripture. The panic of the week becomes your portfolio policy. That is a form of dependence. The independent investor does something more dignified. He studies the incentives. He studies the flows. He studies positioning. He studies what capital tends to do under pressure. He does not worship consensus, but he does not ignore it either. He treats the market like a machine built out of humans. Each human carrying fear, ambition, envy, memory, and career pressure. That machine becomes far less mysterious when you admit it is human. I have always believed that if you can understand incentives, you can survive a great deal of noise. This situation is no different. If the peace path in certain doors open, if the conflict path worsens, other doors open. If you know the doors, you do not need to be paralyzed by the hallway. That may sound too simple, but most durable wisdom does. Before I finish, I want to leave you with the practical blueprint I would use if this were my own capital and I wanted discipline, not entertainment. I would keep a written 2-branch plan. In the calm branch, I would identify the quality growth businesses and sector exposures that were unfairly hit by fear, especially those with strong earnings power and prices that became more reasonable because the crowd panicked at the wrong time. I would also identify the second-order beneficiaries of a softer dollar and improving sentiment. I would know in advance what prices make me interested and what business quality I refuse to compromise on. In the stress branch, I would identify the narrower basket of energy, linked, defense, linked, and inflation. Sensitive names that become structurally advantaged if supply shocks widen and macro fear intensifies. I would know which of those businesses are actually sound and which are simply popular in a panic. Then I would decide what evidence moves me from one branch to the other, not my mood. Evidence: oil behavior, shipping conditions, production risk, earnings quality, capital flows, the direction of the dollar, the direction of sentiment, the behavior of institutions, the behavior of the sectors that should lead if relief is real. That is what an operating system looks like. It does not make you infallible. It makes you coherent. And in markets, coherence is a tremendous advantage. So here is the real test. You can keep behaving like the average investor, which means waiting for the loudest voice in the room to tell you what this week's emotion is supposed to be. You can keep paying the headline tax. You can keep confusing information with structure and excitement with opportunity. Or you can become the kind of investor who understands that money always moves, that fear always crowds certain doors, that relief always surprises the people who were sure the panic would last forever, and that great returns often begin when positioning, leverage, sentiment, and quality all line up while the public still feels sick. One life leads to permanent reaction, the other leads to ownership. One life leaves you chasing whatever already moved. The other lets you stand where capital is about to turn. The market will not force you to choose all at once. It will simply ask the same question again and again in different costumes. Will you be a spectator of panic or a steward of capital? That is the contract. And the market collects on it every week.